All right, folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. And today I brought on a guest to talk about some California specific tax issues. His name is Brent and he's a local CPA. He can introduce himself and tell you where he works. And we're going to get started right now. Go ahead, Brent.
Thanks, Jason. Appreciate you having me on here. My name is Brent Gastineau. I'm a CPA and partner at Gatto, Pope & Walwick, located in San Diego. Obviously, we have a lot of California clients here, being in San Diego, but we also have clients all over the United States. However, a big question I get asked, especially because of the current economic environment and the potential of higher taxes, is how do I escape California? So
yeah, we get that a lot. I see a lot of videos on that right now. Like everyone's saying, "Oh, I'm leaving California. I'm out." And everyone's making these videos on YouTube right now. Some real high profile celebrities have left. Now, you and I have discussed this before. The crazy sort of tax laws were never really going to affect the regular person anyway. It's really targeted at high income individuals. But let's talk about some of the things that you hear about a lot. So let's say that I'm a wealthy guy and I'm leaving California. What do I need to do to prove that I'm no longer a resident in order not to be subject to California income taxes, which are outrageous? And please tell us a little bit about how high those income taxes are and who those income taxes target.
yeah, so I'll start off with that point. California has the highest individual income tax rate at 13.3% for income over $1 million. Obviously, that's a very high income level. It's not hitting all the normal Californians.
Right. What percentage of Californians is that hitting? It's less than 1%, right?
Yeah. In fact, I think that the last study was that there's about, I want to say 95,000 individuals who are millionaires in California, something to that effect.
Out of 40 million people that live here.
Yeah.
Okay.
It's not very many.
Right.
But I also saw, and I guess I should reference it, but that the 1% here in California pays roughly, I think it was 49% of the tax.
Oh, wow.
I could be off there.
Okay.
So
we'll hold you to it. Don't worry.
Yeah, exactly. I should have had that prepared, but but anyway, as far as the tax rates go, these high income individuals are obviously looking at other states and saying, well, wait a second, these other states have such a low rate. Is it a possibility that I can move there and potentially lower my tax burden? So a lot of the questions I get is, well, how do I do it? And I mean, the fact of the matter is a lot of the individuals in California are generally making income because of California, meaning they have a business here or they have clients here. And so to totally extract yourself from California and not pay any California tax is probably going to be difficult unless you're just like a W-2 employee. And there are some that are W-2 and make a lot of money. And
sure, if you're a highly paid W-2 employee, and now with all this remote work stuff going on, it makes sense for some folks to just pick up and move to a different state. It really does.
Totally does. And the question there would be is the employer going to be okay with it? Because there's extra filing requirements for that employer now if they have employees in another state, and it could cause some administrative burden. But the fact is that a lot of employees realize that we can work remote, and if they can do the same job in another state, why it's really appealing, even for employees who aren't making $1 million a year. I mean, it's going to be reducing. The income level is going to be reduced for those who are actually leaving California. And I've been seeing it with my clients too.
Oh, so you're actually seeing income level reducing with people leaving California.
I'm meaning it's not necessarily the upper echelon taxpayers, which we have a lot of. It's even the ones who aren't necessarily the 1%ers who are actually leaving California, because it's now a possibility. I mean, COVID basically was a trial run for can we work remotely. It was a full trial run, and it's been successful for a lot of companies.
Oh yeah, you and I have had this discussion before. I've been working virtually now for 6 years or so, and this is new for a lot of people, but for me, that's been my world. And I said from the beginning of this pandemic that a large portion of people are not going back to work in an office. So it does. You're right. I think it makes sense, and the reasons for leaving California are multifaceted. You're looking at high housing prices here, high taxation, and the ability to work remotely and be able to avoid those two things is pretty strong. But let's say I'm a W-2 employee here at a California company, and let's just say I make $250,000 a year, but I don't want to pay California income taxes. What do I have to do in order not to pay those taxes?
Yeah, so really it comes down to your residency. So California has historically been very aggressive, and rightfully so, because the income tax is high. And there's some really close states like Nevada that have zero tax. And so, California's been aggressive at pursuing those people who escape California, change their residency. I'm saying quotations because those ones who straddle the line are the ones who are really the targets, and the ones who don't really aren't successful in defending themselves as far as residency.
Sure.
So California, the rule with California is that if you're a resident of California, you pay tax regardless of where the income is earned. So it's considered worldwide income. It doesn't matter if you're a California resident, you work in Nevada or Texas or whatever, you're going to pay California tax on that.
Right.
To the extent that there would be a tax paid in another state, you'd get a credit against your California tax, but still you're paying between the two states, you're going to pay the California rate. So really, in order to escape California tax, you need to physically leave California and change your residency and not come back to California. Like, the intention is you have to leave permanently, or else California is going to assume that you're still a resident.
Okay.
And that's because there's a term called domicile, which basically means where are you intending on returning? And if you leave California for a few years and you come back to California after those few years, California would say, well, you really just left for a temporary or transitory reason or purpose. Therefore, that whole time you were gone, you were still technically a California resident, and they would make you pay tax just like you lived in California. So,
oh, wow, that's actually really horrible. So
it's horrible.
Yeah.
Which is why it's so important to establish that I am actually leaving California and changing my domicile, and basically saying I'm severing my ties with California as much as possible. And the way you do that, the California will basically look at certain factors to determine whether or not you've severed your ties or that your connections are more closely related to another state. The simple things that you need to do is you need to not spend a ton of time in California. That doesn't mean you can't ever come back to California, but that's going to be probably the primary.
Like, what percentage of the year needs to be spent outside of California?
Again, it's a facts and circumstances test, but I mean, you definitely, absolutely do not want to spend any more than 6 months. I mean, for sure. And I would say as little as possible. I mean, because the closer you get to straddling the line, the bigger the chance that they're going to look at it. So time is definitely probably the number one factor. Then you start looking at where are your kids located? I've had clients say, I'm going to move to Texas, but my family's going to stay in California.
I can imagine that doesn't really work too well.
It does not work. I mean, not to say that couldn't work. It's a hard argument to make that your spouse is in California and you're not intending on returning to California.
Have you met my spouse yet? I don't. I'm just kidding. I'm just kidding. I hope she doesn't watch this.
And it gets even more muddy because California is called a community property state, and like income earned in California is really attributed 50-50 between the spouses. And it's muddy. It's a mess. So that typically doesn't work. So they're going to look to, hey, where are your kids and where's your family? Where's your principal residence?
Right.
Where is your driver's license registered? That seems like an easy no-brainer to fix. Where did you vote? Where are you registered to vote? Where do you maintain your bank accounts? Where's your financial transactions originated from? So if you're in California if you say you're not in California, but you continually use your credit cards in California, and California can trace that, like, well, you were here, well, that's gonna be a problem for you. So
that's interesting. So where are your financial transactions originating? So let's say that I had a business here in California and I decided to move to Texas and manage my business remotely from Texas. So I've established my residency there. I've got a driver's license there. I vote there, but my business is located in California. My banking relationships are in California. That could be problematic.
Oh yeah. Well, so you bring up even another issue is if you have a business in California operating, generating income, obviously in California, then it really depends on what type of entity is this business. If this is a pass-through entity, like an S corporation or a partnership, that income is going to flow through to you as an individual.
Correct.
And that's California source income. So it's not going to matter if you're in Texas. that particular income, just that business income, is going to be sourced to the state where it was generated.
Okay.
And there's a bunch of other rules with that. But in general, you would still have to pay California tax. Now that would potentially get you out of paying tax on your wages if you earn them in Texas, because wages are typically taxed to the state where you're actually doing the work.
Okay.
So if you have wages, let's say you have a business here, but you're actually earning income as wages in Texas, then yeah, you could avoid the California tax on that piece. Plus, you can avoid tax on all your other portfolio income, like interest, dividend, capital gains. Those are taxed to your state of residence. So if your state of residence is not California, then you're going to be okay on that income. So
it's very interesting. So somebody like Joe Rogan, who got this $100 million deal from Spotify, he moves to Austin, Texas, right before the deal is signed. He's there for 6 months, even though he moved in the middle of the year, and all this stuff takes time to set up. What happens if you have one of those large financial events and in that same year, you're going to change residency in an effort to avoid taxation in California? How do you get away with that?
And it's not to say that you can't leave California because of a big event that's going to happen. The key is going to be that you just need to make sure that you are gone from California, like that you're not coming back. Like if Joe Rogan did this deal in Texas, he comes back to California in 2 years, I think that's going to be a problem for him. I think California would be all over that. So it's going to look funny. I think the chance of his being audited is probably pretty high. I mean, that's a huge deal.
I mean, it's $13 million in taxes that he avoided plus whatever he's making. So
plus it always looks a little weird in the year of change. So because you're going to file a part year non-resident tax return in the year that you leave, and so basically what you do on that tax return is you allocate your income between the period that you were a resident and the period that you weren't a resident. So if your income shows that you made $100 million, but then the amount that you're allocating to California is $2 million or $1 million, California is going to be scratching their head or licking their chops saying, hey, wait a second, I think we have some tax out there that we can get. So, and that's just the way that the taxes work as far as reporting it. But if you had if you could have the choice to have another tax year separation between the event, that's going to be better. It's going to be better information or a better chance of at least not getting audited too. And that's not to say that you weren't a resident. I'm not saying that it's basically that you're avoiding tax or evading tax or trying to do something fraudulent in your tax return. That's not it at all. It's just sometimes if you can wait a few months to close a transaction just so that you don't have to report it in the same year that you changed residencies, if it doesn't make a difference as far as your income and the chance of the deal closing, I would say, wait, just because who wants to have a hassle of having an audit?
Sure. Yeah. But somebody like Elon Musk, though, is probably actually going to have a hard time with this. I mean, his corporate headquarters are still located in California. The huge, factory there is located in Fremont. SpaceX is also located there. The Boring Company is also located there. It doesn't really matter that he's relocated his residence to Texas, and he's still spending so much time here in California that it's probably going to be problematic for him to escape personal income taxes.
There's no way he's going to totally escape California tax. He's definitely going to have some, because I'm guessing he's getting paid a wage. I'm sure he's going to have some presence in California. So there's going to be some wages allocated to California. I know he sold a bunch of residences. I don't know if he owns any property here in California, any rental properties, probably not. But if he did, he'd have to pay tax on that. One of the other tricky rules when you change residency, and I believe that he has some sort of equity-based compensation with Tesla. And so to the extent that he earned, even if it's unvested.
Most of his income is actually equity-based or depending on stock price too.
So to the extent that he has vested, over time interest in incentive stock options, or probably not incentive, non-qualified stock options or so forth, that is actually still attributed to California. So there's an apportionment rule where you have to basically allocate it based off the amount of time that you held the units to where. So how long did you hold those units, those options while you were not a resident? How much did you hold while you were? And you basically apportion it. And there's other tricky rules. So for anybody out there who has like incentive stock options, it gets even more tricky and potentially more beneficial to where you could potentially escape California tax if the timing is right and you do things correctly. So it can get very complicated.
So I mean, the old scenario we think of, or our clients come and talk to us all the time, is like, hey, I can just get an apartment in Nevada, and stay there for 6 months and then come back and it's all good, right?
Yeah, no, that's not going to work.
That's not going to work. Okay.
And they look at, I mean, California looks at the size of the house too. I mean, they're like, okay, you say this is your principal residence and it's a studio apartment in Las Vegas and you have this mansion in Rancho Santa Fe. Something doesn't smell right here. I think I'd be surprised if that's your residence. So right. Yeah, they look at everything. I mean, they're very aggressive and they're not dumb. They're not dumb people. So
that's debatable. I mean, come on, they're politicians, but well, all right. That's really incredible and complete information that's covered there. Let's talk a little bit about some of the crazy things that were proposed by California in terms of taxes and why this is driving some higher income individuals out of California. So we talked about AB 1253, and that was a proposed raise the individual tax rate to 14.3% for incomes over $1 million, and 16.3% over $2 million, and 16.8% for incomes over $5 million. Have we reached a point of ridiculousness here when it comes to taxation?
Well, you would think so, but they keep beating the same old drum. They have the one tool solution, which is raise taxes.
But how does this make sense where, in 2019, California had a budget surplus of $30 billion. And in 2020, got a budget surplus of $15.5 billion, even with the pandemic. How does raising taxes make sense here? I'm not saying this as a political question. I'm saying this like a basic math question. Why are we doing this?
If I knew that, I'm sure I'd be much richer than I am right now. But I mean, really, I don't know. For whatever reason, they feel that they can use the same tax base, raise the taxes, and that nothing will change. Like the tax base will stay the same. And that's really the problem, is that the most mobile people are really the wealthy people. And so they see this potential coming down the pipe, which it didn't pass. This tax rate change. However, I think they see the writing on the wall that, well, it looks like they're going to be pushing for a higher tax, which isn't a surprise. And so these wealthy people have left. I've had a number of clients that have picked up and moved. And
well, the reality is it's more likely to pass here because the real onerous California taxes don't actually affect regular people at all. It's like if you're making under $100,000, your effective tax rate when it comes to state income taxes is usually like under 5%, if I'm correct on that. Plus, your property taxes are limited to 1.25% of the property value. Plus, they can only go up by 2% a year or something.
2%,
So regular people, households that make under $100,000 really aren't paying any taxes, right? They're not paying their fair share of of the expenses for California. So it makes it real easy for people to pass tax raises on at rates that they're never going to be subject to. And so, and I think the most disturbing thing though was the proposed wealth tax. That's AB 2088. I've actually been to countries where they impose a wealth tax, and it absolutely causes a flight of wealthy people out of the country, or at least of their money out of the country. France was a big example of that. They had a number of their elite move their assets either to Monaco or to Switzerland in order to escape some proposed wealth taxes. Those also never passed, but let's talk about EB 2088 for just a second here.
Yeah, so basically it was a tax on the wealth, the net assets, kind of almost like an estate tax, but an annual tax on those individuals who have a net worth over $30 million. And that doesn't include real estate, because real estate's obviously
it's illiquid, right? Yeah.
But this would be a 0.4% tax, which doesn't sound like not a lot, but that was enough incentive for a number of my clients to skip out of California. The biggest problem with this tax that really got people angry was the fact that there was a 10-year residual application of the tax.
Right.
It would basically, over the 10 years, it would get reduced by 10%.
Yeah, but how would that actually be enforceable if someone left?
No, exactly. Like the constitutionality of it, that's the big question: is it even constitutional?
Right.
But enforceable is one thing. Can you even catch these people? And then the second part is like the constitutionality part. So anyway, so this is definitely something that made a lot of people angry, and they just packed up and left, and now they're definitely not going to get that tax from those.
Sure, sure. Now, it's one of the things though, that you and I have lived here for a long time. There's always talk of people leaving California because of high taxes and high property costs, but and high cost of living. But the reality is the population of California keeps growing and people keep coming here, right? Because this is a center of innovation and this is where things are changing and things are happening. Like every single part of the conversation you and I are having right now is developed in California, from the software that we're using for this Zoom meeting, to the computer software that we're using to run on the computers, to the very idea. Everything here is founded and developed in California, including even the programming language and machine language used to code everything. So people continually come here, but that eventually is going to reach a breaking point when we start chasing away the wealthy innovators and people who are funding. These are people who are venture capitalists in a lot of cases, because they make all their money from financial assets. They're picking up and they're moving. I'm seeing a lot of my former clients now who live in the Washington, D.C. area. They're telling me that venture capital dollars from California are starting to show up out there. In Northern Virginia, and they're starting to show up in Austin, Texas, starting to show up in Miami. Anyway, all I'm saying there is that there has to be a limit to this at some point. And I wanted to thank you today for coming on to my show. And this is your first time on, and I'd love to have you back again sometime to talk about tax-specific issues, not just for California, but for U.S. taxes too. And once again, thank you very much. And I look forward to having you on again next time, Brent. And Brent, I will share your contact details. If anyone's interested in your services, I'll put them in the description. All right. Thank you very much. Have a nice day.